to technical analysis proper, right? Technical analysis is the study of patterns in price of a particular asset with the intention of identifying trends and making predictions about future price movements. Basically, when you combine price and volume to speculate the future direction of prices, this is technical analysis. It is done using charts and indicators, right? Now, as opposed to fundamental or sentimental analysis, fundamental analysis where you use the economic events happening in a country to determine its impact on currencies and eventually determine where you think currencies will move, right? Technical analysis doesn't need any of this. What technical analysis is just based on, it's based on patterns, right? It's based on patterns. Technical analysis is based on the idea that patterns commonly repeat themselves, right? If it has happened before, it can happen again. That kind of thing, majorly, right? Like you are looking at the chart and the chart is telling you something that, okay, this is where price is moving, this is what price is doing, right? The price is moving in this particular fashion, price is moving in this particular fashion. That is what technical analysis is about, right? So you are using what you are seeing on the chart, right? What you are seeing on the chart in combination with indicators to determine where price will most likely move in the nearest future, right? So that's what you are doing with technical analysis, right? Now let's go to a chart. Let me show you this. Now this is a chart right here of pound kiwi, yeah. So you'll see that all these things you see here, they are called candlesticks, right? Each of them candlesticks. You can see some are green, some are red, some are green, some are red. And you can see price is moving down, is going down, going up, down, up, down, up, and so on and so forth. You get. So when you come to this kind of chart and you're looking at it and you're trying to determine which by assessing some parameters, you are trying to determine, okay, where will price move next, what direction will price most likely go again. You get. That is technical analysis. That is basically technical analysis. Looking at this chart and trying to use it to determine where price will go is basically technical analysis. Now I must say that, okay, there are like two, when it comes to technical analysis, right? There are like two broad schools of thoughts. Like, okay, there is a school of thought that believes in, I will explain what they mean, right? There's a school of thought that believes in price action. There's a school of thought that believes in indicators. And sometimes too, some will say you should combine them, right? Now, price action. What is price action? What are indicators, right? Now, price action basically just means when the future movement of price is made using historical data on clear price charts without indicators. This is price action at work, right? So price action just simply describes the action of price over time. The way price has moved over a given period of time is price action, right? So now back to that same chart, right? Back to this same chart, right? Now you can see that all I have here is just the chart. This chart. I can decide to put indicators. Let me put checking money flow. Let me put this, right? That's an indicator down there. You can see this green wavy line, right? That's an indicator. I can decide to add another indicator. Let's say I put the mark D, right? So I have another indicator down here. But with price action says that you should not even put any of these indicators, that you don't need any of them. What those indicators do is they also have values on them that guide you to tell you when to buy, when to sell, when to buy, when to sell. We'll touch on indicators later. But price action basically tells you you don't need these indicators. You're not using indicators. You're using a naked chart. This is a naked chart basically. So I can also have indicators going on the chart, right? So indicator going on the chart will be your something like your moving average. For example, you can see the blue line now that I just drew on my chart, right? So that is an indicator going on the chart, right? So if I remove that, the chart is naked. So price action basically deals with a naked chart, right? So this is showing historical data about price. Now if you look here, you see this is D. It means 1 day. I'll explain candlesticks in a minute, right? It means 1 day. So this is showing historical data as far back as you can go, as far back as you want. You can see my cursor, where my cursor is down there. If you see 26th of May 2020, going like that, going through the months like that. So it's historical. You can go as far back as you want. You can go as far back as you want, as far back as you want, as far back in history as you want, right? But let's just stick with this for now. So price action basically just says, okay, what has price done in the past? How has price reacted in the past? We are not looking at any indicators, just looking at this price, how price has been moving before, how it has moved up. Okay, at this point it moved down, at this point it moved up, at this point it moved down, at this point it moved up, at this point it moved down. That is what price action basically has to do. It doesn't use indicators. That's what price action tells you. Now, price action, the fundamental thing you have to understand about price action is largely dependent on candlesticks, right? Candlesticks are representations of how price has moved in a specific period, right? So it shows price at open, close, at the high, and at the low during period of interest. I'll explain what I mean by all that. Each candle represents a unit of whatever time frame is being looked at. So now, what does all this mean? I'll explain in a bit. Now look at this. Let's go back, right? Like I said before, all of these things you are seeing here, these green and red things you are seeing here, each of them is a candlestick. Each of them is a candlestick. You can see they look like candles, right? Each of them is a candlestick. And what we mean by they can represent whatever period that you select. What we mean by that is you can see this is 1 day, right? This is 1 day. That means that each candle represents the movement of price in a single day, right? In a single day, movement of price for each day. So you can see where my cursor is now. That down there you can see 29th of July 2020, 28th of July 2020. So it's showing the candlestick for 28th of July 2020, right? So it's showing the candlestick for 28th of July 2020. That is the movement of price. That candlestick captures the way price moved on that day, right? So that is what candlesticks are, right? That's what candlesticks are, right? Now, what does this, like, how are these candlesticks formed, and what is the anatomy of a candlestick basically? So now, just come along with me. Let's come along with me, right? Okay, so now you look at this. Look at where my cursor is, right? You can see one of this candlestick is blue, this candlestick is white, right? It's deliberate. Right? Now I'll tell you why. Now you can see here bullish candlestick, bearish candlestick. Now I must also say another term we need to mention in Forex. When we say bull, Bull is for price going up. Bullish, when we say bullish, price is going up. Price is going up, right? Bullish, bullish, price is going up. Bull, bull. So those that are buying, the buyers are called the bulls, right? Buyers are called the bulls. They are driving price up. If you are buying, you are driving price up. You are a bull. You are bullish, right? If you are selling, you are driving price down. You are a bear. You are selling. You are bearish, right? So you can just imagine it as how I like to imagine it is a bear. A bear is a bear wants to tear down with those claws, those mighty claws. Just wants to tear down something, just tear everything down, bring it down, bring everything down. I'll off and puff and bring everything down. I'll tear it down. So bear, bearish, right? Bull, bull is always advancing, always want to clear everything in its way, always up, 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 right? So that's how I like to think of it. So bullish and bearish. Now, if you look at these two candlesticks here, right? This one here is a bearish candlestick. This one here is a bullish candlestick. I will explain why very simply. Look at this bearish candlestick. You know we said bearish means price is going down, right? So it means that a bearish candlestick means that a candlestick that shows that price has gone down, basically, right? That shows that price has gone down. So if you have a candlestick that is bearish, it means that price, let's say is a daily candlestick, like we saw on that chart. Let's say it's a daily candlestick. Let's say it represents a daily time frame, right? Let's say this candle represents 1 day. Let's say it represents 1 day. It means that for that day, the candle for that day, this candle for that day, price closed lower than it opened. Okay, first of all, let me explain what open and close is. So look at this candlestick, right? You can see this top here. Look at, okay, this is called the body, right? This is called the body. Look at it, real body. The rectangle without the lines is called the body, right? Now when you now look at the lines, right, just the lines are called the wicks. It's just like your normal candle, right? This is called the body, the lines are called the wicks, right? Now this body, right, has a top and a bottom, right? It has a top and a bottom. The top and the bottom, depending on what kind of candlestick you have, whether bearish or bullish, the top and the bottom can be either open or close. Just get that. The top and the bottom can be either open or close, right? Now the wicks, for the wicks that you're seeing, right, the wicks usually end with the high and the low. The wicks usually represent the high and the low for that time period, for that day. Let's say it's a daily time frame for that day, right? So now let's focus on the body for a moment, right? So now for a bearish candlestick, if we are saying that the body will show you the open and close for the day, now if something is bearish, that means that price is going down or price has gone down, right? It means that the price, like where price opened for, let's say it's a daily candlestick, we've already established that. It means that where price opened for that particular day, where price opened for that particular day, price closed lower than it. What do I mean by that? Let's say for example, price opened at 2. Let's just say 2, an arbitrary number 2. Price opened at 2, right? And price now closed at 1. Of course, 1 is lower than 2. So that means price is coming down. So price has come down to get to 1. Price started at 2 and it came down to get to 1. So that means price closed lower than it opened. So that is a bearish candlestick. That is a bearish candlestick. But for a bullish candlestick, right? For a bullish candlestick, that means price has gone up throughout that day. Price went up, right? So that means price closed higher than it opened. So that means, let's say price opened at 1 and closed at 2, right? So price closed higher than it opened. So for a bearish candlestick, price closed lower than it opened. For a bullish candlestick, price closed higher than it opened, basically, right? So that is open and close, right? That is open and close. So that's how you know a bearish from a bullish candlestick, right? So you just look at it, you look at the price, where price has closed for that day. Now look at the wicks or shadows, right? The wicks or shadows, the end of the wicks indicate the high and low for the day. High and low for the day. So this high means the highest point price got to for that day. The highest point price got to for that day. While the low means the lowest point price got to for that day, right? Now, don't mix it up, right? The fact that price got to this highest point for that day doesn't mean it will stay there. So it's still different from the open and the close. It's very different. The fact that price got to this low for that day, it doesn't mean it will stay there. The same thing for the bullish candlestick. The fact that price got to the high for that day doesn't mean it will stay at that high. It will still come back and close at some point. So it will close here. So it went this high, then came back and closed here. So basically, this candle now, let's describe this candle. This candle opened here, right? This candle opened here, right? Went down like this, made this low. This was the lowest it came, right? It came this low, it started going back up, went back up, went back up, went back up, came this high, made this high for the day, right? Then now came and closed here. Let's go over that again. This candle opened here, right? Came low and came to this lowest point like this, right? Now it went back up to the open. From the open, went back up to this highest point. So made the high for the day, right? Then came back down and closed at this point. So that is how this candle went. That is how this candle moved, right? Now, having understood that, with price action, these candlesticks are very important with price action, because the candlesticks, like the way they are patterned, right? The way they are patterned, it shows how price behaved for that day. And according to that school of thought of price action, it can give you a good idea of how price is behaving and how price is likely to behave in future, right? It can give you a good idea of how price is behaving and how price is likely to behave in future, basically, right? Now, I won't touch on everything. Because like I said at the beginning of the course, right, I will really be focusing on my own style of trading, but some of these things I will mention them because some of them are basic stuff that you just have to understand to get started, right? So I won't really be delving much into it, but I'll mention some common ones, right? I'll mention some common ones. So now here you can see candlestick patterns. There are different candlestick patterns, right? So here you can see single candle patterns. Yeah, showing you hammer, inverted hammer, dragonfly doji, bullish spinning top. So what is just basically saying, if you look at this hammer now, you will see that the body is on top and the wick is down. It doesn't even have any wick on top, right? It doesn't even have any shadow or wick on top, right? So it's just body, then under it is a wick. So it looks like a hammer, right? It looks like a hammer, right? So it's showing you that It's showing you that price started at the open, came all the way down and made this low. It made this low, then went back up to the open, then went up and made this high and closed at the high. That is why you can't see any wick. It closed at the high. So it got to that high and closed there. That's what formed this hammer, right? And price action traders will tell you that this hammer, right, it is a bullish candlestick pattern, right? And depending on where you see it, right, it is highly indicative of price going up very soon. Price will go up very soon. So when you see this candlestick pattern, it's telling you that price is most likely to go up very soon, right? Another on inverted hammer, right, is also a bullish candlestick pattern. It's telling you that price will go up very soon. Look at this dragonfly doji. Look at this one, right? It's almost like the hammer, but the only thing is that you don't even have a body, right? It's just a very tiny body, you get. So what happened, what led to that is price opened, right? Price opened, came all the way down and made a low, went back up to the open and closed at the open. So price closed at the open, right? So it's forming what is called a dragonfly doji, right? It's forming what is called a dragonfly doji. So this also is very indicative of a bullish market, a market about to go up. Price is about to go up when you see this. Like that's what price action traders will tell you. Price is about to go up, right? Um, all this here, the opposite is just what you have here, right? So for bearish, the opposite is just what you have here for bearish, right? So two candle patterns. You also have two candle patterns, three candle patterns. They'll tell you that when you see some candle patterns, they are more likely. It is more likely that the market is going up or going down, depending on which one you see, right? So look at some common ones. Look at this bullish engulfing. Bullish engulfing just means that you have one candle formed. This one is okay, a bearish candle. This one is a bearish candle, quite all right? But the next candle is now a bullish candle that is way bigger than that bearish candle that formed before, right? So it's like that bullish candle, it's engulfing the previous candle, right? Because it's way bigger than it. The entire body is engulfing the entire body of the previous candle. So it's a bullish engulfing candle, right? The next one, look at this one, bullish arami. So it's just basically a bullish candle following a bearish candle. Here you can see it's within the body. It's within the body of the previous candle. So the opposite is what you have for the bearish candle. You also have all these things. You can have them in three candle patterns. Like it's a whole lot of it's a whole lot to go into. As we go on, we might get to learn more of these things. But I must tell you, I'm not a price action trader, really. So I'll just tell you what you really need to know to get started. I'll tell you what you really need to know to get started and trade correctly and trade very well as a beginner, right? We won't go in depth into this price action patterns, really, right? So you have Morning Star, Abandoned Baby, Three White Soldiers, a whole lot. There are so many of them. You don't need to bother your head about all of them now. There are so many of them. What I just want you to take away from this is candlestick basics, the anatomy of the candlesticks, how candlesticks form, how a bearish candlestick looks like, and how a bullish candlestick looks like, right? Then candlestick patterns, some common ones. You can, having understood this now, you can try to look up some candlestick patterns and see how they form, and see what must have formed them, right? So you better understand what we've been talking about, right? So okay, So the chart I opened before, right? You can have not just candlestick charts, you can also have line charts. I'll show you what I mean by that in a minute, right? So I come here now. Right? What you are seeing here is a candlestick chart. Yeah, you are seeing a candlestick chart. But I can change this to a line chart by just coming here, and clicking line. I click on line. You can see this has changed to a line chart. This has changed to a line. Is a line chart, right? Is a line chart, right? But the thing about this line chart, right? Like this other, in fact, you can see that there are other options there for you to select, other options there, but it's been found that the best thing, what gives you the best chance of success in trading is still candles, you get, it's still candles basically. So you don't want to compromise your candles for anything, just for learning purposes, to know that okay, there are other kinds of charts, but you just want to stick with candlesticks, right? Now one thing you want to know as a forex trader that is very important, right, is trend, right? Trend. What is a trend, right? A trend is the general direction of price movement. It's the general direction of price movement. Now in forex, right, the best thing you would do for yourself, just if you don't hear anything again in this lesson, just hear this please, right? There are a lot of forex traders out there that want to teach you. They will tell you, they can teach you how to make money, how to make fast money. They will tell you you reversal, there's something called reversal trading, you get. But it's just good that I'm mentioning it now from this onset. Like I might just decide to okay keep it till later, but let me just mention it once and for all now, right? Your best bet, your best bet in forex, right, is trend. Is a trend. Your best bet in forex is a trend. There's a common saying that the trend is your friend. The trend is your friend, right? What does that mean? The trend is your friend. When something has been happening, right? When X has been happening, right? It makes more sense for me. Okay, X has been happening for the past 1 week, right? Now I'm waking up this morning and someone is asking me to predict, okay, will X happen today, or it is Y that will happen? Will X happen today or Y will happen today? It only makes sense for me to like last week Saturday X happened, Sunday X, Monday the same thing, Tuesday, Wednesday, Thursday, Friday the same thing, X. It only makes sense for me to, I mean, my odds are better by saying that X will happen today. Yes, I think X will happen today. So that is what basically a trend is, right? Your best bet in forex is to follow a trend, right? That is just the truth. You get. So you are more likely to go with X happening again because X has been happening, right? Even if you do fail, you will know that you went with what had the higher probability or highest probability of happening, right? So a trend is what you are looking to follow trends. Just hear this. If you don't learn any other thing from this course, just learn that you are looking to follow trends, right? A trend is very, very important. Now, you can have an uptrend. An uptrend occurs when price tends to be moving upwards, right? An uptrend consists of higher highs and higher lows. A downtrend is seen when price tends to be moving downwards. It consists of lower highs and lower lows. A side trend or range is the movement of price, which consists of roughly equal levels of highs and lows. Don't worry, don't bother. I'm going to show you everything on the chart right away.